Good morning, my name is Kaylee White, and these are my teammates, Aiden Minkin, Taylor Pinch, Matt Flowers, and Josh Stevens. We represent Harding University of Searcy, Arkansas. Our presentation this morning has two parts. We will begin by analyzing qualitative factors about Chicago Bridge & Iron, stock symbol CBI, before we move on to our analysis of the company's financial statements and stock. One of the first things we noticed about Chicago Bridge & Iron was its misleading name. The company is neither headquartered in Chicago, nor does it build bridges. Rather, they're based in the Netherlands, and their business is to provide engineering, procurement, and construction services to the energy industry. CBI is comprised of three segments: steel plate structures, project engineering and construction, and Loomis Technology. The diversity of these three segments allows the company to provide substantial projects at what they call concept to completion. Management strategy is working. Last year, revenues grew 24%, and the profit margins are leading the industry. Looking forward into 2013, management has identified three initiatives to help promote growth. They'll acquire Shaw Group, they'll expand their market share in liquefied natural gas, or the LNG market, and they will do some debt management. In light of these points, and coupled with our analysis of the company's stock, we are confident in price target of $79.44 and recommended buy of CBI stock at $68.80 or below.
So CBI is in the engineering, procurement, and construction industry, EPC for short. EPC companies design and fabricate facilities that store and refine natural gas products and oil. These projects are large in size and global in nature. Currently, we have defined three industry drivers. The first is the movement towards hydraulic fracturing. This technology has monumentally increased access to natural gas deposits and consequently has begun to increase expectations of LNG demand in the U.S. up to 16% over the next 12 months and 50% internationally over the next 5 years. The second key market driver is the continued industrialization of India and China. The World Bank forecasts a global economic growth rate of 2.4% in the year 2013 and 3.1% in the year 2014. The UN predicts that India and China will expand at a much faster rate of 6.1% and over 8% respectively. With a combined population of over 2 billion and with relatively low per capita energy consumption, it's almost a certainty that demand for energy in India and China will be high for the next few years. Third key market driver is the global focus on climate change. The industry has already seen revenues from increased activity in alternative energy. We believe CBI is well positioned to take advantage of these industry trends. The first reason is that CBI is the industry leader in LNG and was the first company to design and fabricate LNG storage containers. The second reason is that CBI already has significant market share in fast-growing international markets. CBI owns over 30 facilities in 17 countries, including India and China. Lastly, management has added scale and services so that CBI can successfully pursue its strategy of concept to completion. With the acquisition of Shaw, it's emblematic of their business plan and will significantly magnify their capacities, services, backlog, personnel, locations, and cash flows.
CBI's key risk factors can be divided into two categories, internal and external. The first internal factor is the pending acquisition of the Shaw Group. Although we anticipate a very successful merger, if this acquisition is not completed, this could have a negative impact on CBI's stock price. The second internal factor is the impending 200% increase in backlog, as CBI may be unable to fulfill some of these terms of each project, and the customers may back out of contracts. The third internal risk factor is the contracting terms sensitivity. CBI's management is working to reduce this risk by engaging in more cost reimbursement contracts rather than the fixed cost contracts or the hybrid contracts. And the fourth and final internal risk is cash flow management due to the awarding, timing, cancellation, delay, or reimbursement of contracts. The key external factor is industry activity. CBI's future revenues would be negatively impacted by a reduction in the level of activity in the hydrocarbon industry. Factors like global environmental, political, and economic factors can negatively affect this industry as a whole. Despite all these risks, we are very optimistic about CBI's future because we believe the positives of this company far outweigh the risks.
Financial statements support and reflect the company's growth in many ways. We expect revenues will reach $5.4 billion in 2012, continuing a growth rate of 18% year over year since 2007. Following the Shaw acquisition, we predict that revenues will reach $12.6 billion in 2013. Gross profit margin has grown from 8.2 to 12.8% in the past 5 years. Over that same time period, operating profit margin has grown 11.9% annually. We expect to see net profit margin reach 5.8% in 2013 following the Shaw acquisition. This would be CBI's highest net profit margin in over a decade. As far as their balance sheet is concerned, we see liquidity improving. The current ratio has grown from 0.6 to 1.06. We see accounts receivable turnover accelerating from 7.8 to 10.6 times a year. We attribute this to management's ability to enhance the company's cash flows. We predict that the return on equity will increase materially as a result of the Shaw acquisition, with $2.2 billion worth of liabilities being added to the balance sheet. This will lever both balance sheet numbers and return ratios. Finally, we see that even with an addition of debt, we believe that they will continue to attempt and keep their debt to equity low. In terms of cash flow, we see that CBI has positioned itself well for the Shaw acquisition. We see their, as I said, we see their receivables turnover increasing. We see payables increasing as well. And we see them cutting back on capital expenditures. They've used this additional cash flow to build up treasury stock, which we predict they're going to use in the upcoming stock swap with Shaw.
To determine the point target price for CBI, we employed several valuation methods. This included discounted cash flow, enterprise value to EBITDA, price multiples, and the dividend discount model. The results of our analysis was a target price of $79.44. For discounted cash flows, we created a multi-stage growth rate model to forecast future cash flows for each company. For the first year's growth rate, we calculated a 10-year CAGR of CBI's free cash flow of 18.74%. We then decreased this rate each year until we arrived at our terminal growth rate of 2.5%. This reduction is due to the very large size of the company post-acquisition. Our terminal growth rate of 2.5% reflects a conservative estimate of long-term global GDP growth. This analysis resulted in a likely price of $76.41. To test the sensitivity of our discounted cash flow, we varied the terminal growth rate by plus or minus 0.5%. This generated a range of prices from $73 to $80. We then varied the weighted average cost of capital by plus or minus 1 percentage point, and this generated a price range from 65 to 92. Our weighted average cost of capital consisted of two components. We calculated the cost of equity using the capital asset pricing model. The variables included in our CAPM were the 10-year U.S. Treasury rate of 1.84%, an expected market return of 9%, and a weighted average beta of 1.93. We calculated the 5-year beta for each company and then took a weighted average of these betas based on each company's respective market cap. We calculated the cost of equity to be 15.56%. We then calculated an after-tax cost of debt of 4.17%. As I mentioned earlier, we did an enterprise value EBITDA analysis. We calculated a 10-year trailing multiple for CBI and a 5-year multiple for Shaw. We then took a weighted average of these multiples based on each company's market cap. We then paired this forecasted multiple with our projected combined 2013 EBITDA. This resulted in a likely price of $85.85. To test the sensitivity of this analysis, we varied the multiple by plus or minus 2 times, and this generated a price range from $79 to $97. Finally, we did price multiple analysis over 10 years of history. We used a line of best fit to eliminate outliers and then selected high, low, and likely stock prices based on these multiples. We then took a weighted average of these stock prices and generated a likely price of $76.92. To test the sensitivity of the PE multiple, we varied the multiple and earnings per share. This generated in a price range of $70 to $99. We also did a dividend discount model, but the result was not meaningful or reliable. After weighing each of our analysis, we came up with a target price of $79.44.
In conclusion, we're confident that our financial forecasts and analyses are supported by reasonable assumptions and accepted methods. Therefore, we suggest a 12-month target price of $79.44 and a buy point of CBI stock at $68.80 or below. Thank you for your time and attention. This concludes our prepared remarks. We'll now take your questions.
So if your data was roughly 2,193, I think, how did you come up with a weighted average cost of capital of only 20%?
Well, after we calculated the weighted average cost to be 10.53% is because our weighted average beta, I calculated 5 years back for each company to get 2.26 for CBI and 1.43 for Shaw, weighted average of 1.93. We had new debt coming in from the merger, and existing debt from the Shaw would be bringing to the rest of the combined company. So combining those together, we ended up with a weighted average cost of capital of 10.53%.
So what did you assume as an equity market risk premium?
Equity market risk premium, please. Are you asking me what variables we used in the cabinet analysis?
That's one of the variables.
Okay, we used the expected market return of 9%, and then a 10-year U.S. Treasury rate of 1.84%.
The follow-up question, the cost of capital, based on your calculation, cost of equity is higher than cost of debt. Is that correct?
Yes, sir.
So what's the impact on your capital structure for the combined company?
Well, with the increase in debt, we believe that there will be a shift. It may actually move towards liabilities. Right now, there's exceptional debt management. Their long-term debt is actually zero, their debt-to-equity ratio at CBI. They're bringing in, I believe it's roughly $1 billion in long-term debt with the Shaw acquisition, a long-term note that they're using to finance the acquisition.
So did the Shaw acquisition actually close?
No, it's not.
No, it's pending.
It will be up for vote. I believe next month.
When was that announced?
It was announced
July.
July 30th.
We went ahead and incorporated Shaw into each of our analysis, just because at this point we are expecting the merger to happen. CBI shareholders have already approved it. We're waiting on Shaw shareholders to approve it later in the month.
So do they have antitrust approval in the various jurisdictions now?
When we spoke with Investor Relations at the beginning of this competition, Investor Relations was very optimistic of the merger and basically said that there's very little risk of it not going through. However, for conservative sake, we have to include that specifically.
I'll echo one more point. The last voting that they did with the shareholders was, the approval was over 80%.
With regard to the risk factor and risk classification, I like your classification to internal and external. But what management or board of directors doing in assessing those risks that you mentioned and making sure that those risks are being managed properly, especially after acquisition?
After acquisition, CBI's management will take over. There's a very vast majority of CBI's management taking over. And as we pointed out, the acquisition is one of their top priorities right now, as is their share of the LNG market, as that seems to be the leading market in the hydrocarbon industry. That is what's taking over. So management is just doing everything they can to reduce those risks because they have them prioritized. And CBI's management will be in charge after post-acquisition.
In fact, Philip Asherman, current CEO and president of CBI, when he came on in 2006, a lot of the positive trends we noted in their ratio and margin analysis began with his coming in and beginning to lead the management team.
So the incumbent management at Shaw will leave the company, or are they going to stay around, or what's going to happen?
Very little has been announced regarding Shaw's executives, but it has been very clear throughout all of our research that CBI's management will take over Shaw's management will not very well carry over into the
Shaw's top management has shown to be selling the majority of their shares of the company in the last 2 months. Like most of them are just releasing all of their stock options.
But where the synergy comes from, if the management team not going to be combined using the skills of both companies, what are the areas of synergy for this combination?
Shaw is a current competitor of CBI, and already know. CBI in the past has acquired other companies, for example, Numis Technology, which is now one of their 3 segments. They've been able to show in the past very successful acquisitions, and they've been able to incorporate those seamlessly into their concept to completion marketing strategy. So they'll be able to provide more extensive services to consumers.
Whenever we had a conference call with management, they projected that the synergy of the 2 companies would be $115 million in EBITDA a year. They said that CBI is really good at building the tanks and has a lot of the technology. And Shaw's technology will just complement theirs and increase their gross profit margins.
And the risk of incompatible technologies and things like that we've seen with Sprint Nextel and other such mergers isn't really a risk factor because they're the leaders in creating the technology. They are the ones establishing the trends and the methods within the industry. Oh, additionally, to your question about where specifically, a lot of it seems to be redundancy elimination. Both of these companies operate, Shaw operates a lot more in the U.S. CBI already has a presence here. Some portion of personnel and physical locations will be sold off, and that's where a lot of reduction of their...
But their future business would be primarily in Asia, is that correct?
They're a very global company, and you can give more
Well, a
information.
lot of the expanding markets is, like I said, India and Asia, specifically places that are becoming industrialized, growing. I mean, you know, they're going to need light, heat, mobility. So any expanding markets, Australia is a huge expanding market for LNG. 80% of Shaw's business is done within the U.S., whereas a lot of CBI's is global. So those synergies will match up perfectly and you know, go towards where the growing industries and markets are.
So what's your target price if the steel falls apart?
Well, if
In
steel
your
falls apart,
recommendation.
obviously our target price would drop, you know, significantly, you know, just along with the entire global economy and commodity prices. If that were to happen, we would, you know, have to recalculate, and obviously we project their, you know, EBITDA to be lower. That would change just, you know, all of our valuations to a lower price. So it would just be based on how much steel failed, and we'd have to calculate the valuation. And, you know, I guess that's kind of, it is incorporated into our sensitivity analysis for each model based on our low prices. That would account for falling prices of steel.
What about the reliability of the dividend discount model?
Well, CBI's dividend history is erratic. They went a couple of years without paying, and they paid a 6-cent dividend, and then jumped up to 40 cents. Shaw's never paid a dividend. Many of their biggest competitors do not pay dividends. So there were just too many assumptions, and we felt like the reliability of our other analysis was so much stronger than the dividend discount model, just because of the nature of this company.
Over the past 10 years, CBI had a dividend that was steadily growing, about 4 cents every 2 years. But around 2010, they actually cut their dividend entirely. And we attribute a lot of the lack of consistency or reliability to that sudden loss of dividend.
Maybe have time for one more question?
What did you learn about the corporate governance of these two companies, the board of directors, top executives? How do you evaluate the performance, the effectiveness? Anything you say?
I mean, it was very easy to look at top management and see that because of it being a relatively low margin industry, CBI being much higher than most of their competitors in those regards, it was easy to see that things like debt management were at a premium for the company's executives. Again, as of 2011, they have 0 long-term debt on their books. This obviously will change with the financing of the Shaw acquisition, but they seem, because that is such a risky industry anyway, there's such fluctuations year to year and inconsistent timing and payoff of contracts, they I guess decided they want to release or remove any chance of having to pay out additional cash in long-term notes and that sort of thing.
I'm an accountant, so let me ask you a question about did you look into the audit report during the past several years for these companies and see whether they got clean opinion from the external auditor with regard to their financials and the risk involved or anything else?
I haven't seen anything other than a general clean report. They haven't.
Unqualified.
Yeah, unqualified. They haven't given any reason for us to question the material nature of the reports.
And as you can see here, most of the officers have come since 2006, and that's when we've seen CBI really take off. They have almost a whole new management team. So we're confident that that management team can, incorporate Shaw into their operations and continue to be successful and improve margins and manage debt like they have in the past 5 years.
Not that we value auditors' opinion much, but.
All right, thank you very much.
Thank you.